Good afternoon to everyone, and welcome to you all to today's online seminar organized by the Florence School of Banking and Finance on the topic Consolidation in the European Banking Sector. My name is Elena Carletti. I will be chairing the seminar today. So let me welcome first and introduce the speakers in the order in which they will appear. We have Edouard Fernandez-Bollo, who is a member of the Supervisory Board of the European Central Bank. Welcome back. We had the seminar with you recently. Then we are happy to have with us Diego De Giorgi, who is now an independent director at Unicredit, SPA, but he is a former global head of global investment banking at Bank of America and Merril Lynch. So welcome to our webinars. And then finally, we have Andreas Dombret, who is now at Columbia University, but he has a sort of combination of profile. He is actually the first M&A banker that has joined the board of the Bundesbank, and as such also as a member of the Supervisory Board of the European Central Bank. And he's also an exception given he is German and American, as I remember from my times in Frankfurt. So he has a very special, in a way, profile. So thank you to the three of you for joining the discussion today. So the starting point for the webinar today is the new public consultation that the SSM has recently started on the guide on the supervisory approach to consolidation in the banking sector. This is clearly a very important consultation process in our view. We very much hope that this will help restart the consolidation process in Europe that we have seen a bit stalling since the last crisis. So we are very happy to have Edouard. We understand that this is very much his process in the SSM. So we are very happy that he is with us and explaining how the guide tries to clarify the approach that the SSM will follow when assessing a potential transaction, both in terms of phases of the communications and approvals and so on, but in particular how the SSM will consider the key prudential aspect of the consolidated entity. So the capital requirement, the treatment of badwill, and the use of internal models more in details. In terms of organization, Edouard will then go first. He will have 10 to 12 minutes. Then we will hear the market view with Diego, and finally the combined view, if we want to say it this way, from Andreas. And the two commentators will have about 5-7 minutes. I kindly ask you to stick to the time so that we can then open the floor and have a debate. And I remind that in the debate, you will all go back to be equal panelists in a way. So now let me turn to the participants. First of all, thanks for participating despite being July 21st. I understand we are asking a lot today. So you can remember that you can ask a question in the Q&A box that you find at the bottom of the screen. Please don't use the chat box. And I will collect your question and will pose them to the speakers. If you can, please ask a brief question and we indicating the name of the person you would like to address the question to, if there is a particular addressee. With that, let me give the floor to Edouard for his initial remarks, please.
Well, thank you very much, Elena, and thank you for providing me this opportunity to speak to you again today. In fact, we are in the process, as you told, to try to interact with the public at large on the principles of a supervisory approach to consolidation. So this is an opportunity that is very much welcome to do that. Let me see if I can share a presentation that I have there. Let's share. I hope it is, and it is in full screen mode. Perfect. Okay. Well, thank you then. As a preliminary thing, I would like to express why we are doing this and what we are doing this. Why we are doing this, it is of course because we are a very special supervisor. We are a supervisor that now is European-wide. Since 5 years ago, we've turned a system of supervision that encompasses all the supervisors in Europe and has at its center the European Central Bank. So for the European Central Bank, it is more than natural to speak and to think European-wide. And when we speak and we think European-wide, like everybody else, we see that it is not yet, even if legally one can discuss it, it is not yet a single market. We still do not see Europe as a unified banking market. And one of the reasons that is there is that we still have of course, different economies, but still have fragmented banking systems. And I will say even that after the first great financial crisis, there was, I would say, a comeback to fragmentation. The market was difficult to unify. We are now again in a crisis, but we think that one of the responses of the crisis is further integration of the market. So as supervisors, we are here and see the benefits of the integration of the markets. And on the other side, and I think we should be very, very clear about that, this integration should be a market integration led by market forces that see benefits, industrial benefits, to fight, I will say, the structural problems, in particular of profitability, that we have in the Eurozone and in the European Union as large, by the way. So it should be an industry move, an industry-driven move, but here as supervisors, we have a role to play. And what we want to, with this consultation, signal to the market is that we are really ready to play this role. Our role, only our role, but fully our role. And just one of the things I put in this slide, one of the things that is not our role, even if I expect that we may speak about it, is to change the legal provisions. So the supervisor is there to apply the framework as it is. So we have to understand everything that is in the paper, that is in the consultation, as being with a clause ceteris paribus. So all things stand equal as they are today. So we are trying to do something in the present framework, not waiting for the framework to change, even if, of course, there could be an issue whether for integrating more the European Union, we don't need additional changes of the framework. But what we are doing, what we are talking today, is something that is not linked to any change in the framework. So given this framework, what we wanted to do is to clarify how, as supervisors, and with the powers and roles that the present framework is giving to us, how we will approach this consolidation. And why? Because when I joined last year the ECB, one of the things that struck me is that there were a lot of misapprehension and misconceptions about what were the role of the supervisors. And for instance, and to be clear, one said the supervisors, they only see risks. So as they only see risks, they will be a hurdle in the process of consolidation. And I just wanted to, when I say I, it's us, the ECB and the SSM as a whole, we just wanted to have a clear balance to explain what we are doing. What we are doing is to weight the risk and benefits of the operations. So we have a balanced approach, but because this is exactly what we have to do. We have to exercise judgment when, again, it's the market that creates projects. They bring us to us because essentially, I will say for our base case is a bank buys another bank. There can be some other cases, but we are speaking for simplification on this base case. In this base case, we need to approve one bank taking over another bank. And so here we have to confront to the projects that come from the industry and to see, to check whether they are, from a prudential point of view, sound. What is a sound project from a prudential point of view? First is that it is predictable, and second, that it is so it's credible. We can believe in what will happen, and second, that it will improve the resilience of the combined entity, and so of the banking system as a whole, if it goes until the end. So what we wanted to do is to give a clear signal to the market how we will treat this process. So to increase clarity, so that the market, when it is in its role to make that project, and again, we are not directing the market, we are just assessing the projects of the market, can integrate in advance what will be our approach. And the message is it will be a flexible and proportionate approach. So it will be flexible, so we can take into account the benefits of the project and not only the risk. And it will be proportionate. It will be proportionate to, as I say, our judgment on the project. Is it predictable? Is it credible? Does it increase reliance? And if we have these conditions that are met, then we can use the flexibility that I will explain just now. There were 3 points that stemming from our previous contacts with the market, but again, we are here to discuss whether these are the most important 3 points that appear to us as being the ones that are, again, let me underline that, in our power. This is something we do, not everybody else. It's something that the ECB, when it's in liaison, in fact, this is joint procedures with the national competent authorities, so SSM, ECB, and the NCA together, they have to take decisions. These are things that we have to take, that are in our remit, so that depend only on us. And on these things, we had three principles that we wanted to say to the market. First, talk to us as soon as possible. Clearly, it's very important if you want to get feedback to see how it will go. The sooner you get in touch with the supervisors, the better it is. Second is that what we want is to check the sustainability of the projects, and this is what we will be looking at. And third, of course, we will, if we think that the project is sustainable, and so we grant some flexibility because we believe in that project, then we'll have to monitor very closely how it evolves to be sure that this is really going well. And given, in this case, where we think a project is credible, the 3 main points we wanted to communicate with the market as a whole is first, on the issue of the capital requirements. And again, we are speaking about the capital requirements that are set by the supervisor. Of course, there is a framework, regulatory capital requirements, but we are centering on the ones that are set by an individual decision of the supervisor. And here, what we wanted to say is first, that we have no bias in a consolidation. So the starting point is the weight average of the involved entities, which is the neutral point. And we can go upwards if we see more risk than benefits in the project, but we can go downwards also, which is maybe something that people didn't realize very much. That we can also go downwards when we are confronted with a project where we see the benefits of it. Second point, which is important, I think, in this first phase, is that we, of course, subject to the fact, as I think that the plan goes normally, we can commit to have a stability for this. If the plan goes as planned, we will not review unless there are new circumstances or what will be our determination. So that's again to give predictability to the plan. We ask the plan to be predictable. We are ready to be predictable also when we rule on these issues. Second point, second point of substance is on the badwill. Unfortunately, this is a point that, given the valuation of the banks today in the Eurozone, it's a very important point because any transaction is of course, a possible generation of badwill. And the first thing, which is only the regulation, but it's better to be said, is that if we have duly verified accounting badwill, this goes in the prudential own funds. There have been other misperceptions in the market, but we want to be very clear about that. The second point is that, of course, when we are looking at own funds from a prudential point of view, what we want is that the own funds are there to reinforce the sustainability of the combined entity, to be able to face the risks that we will have when we have a combination, to upgrade, of course, the resilience of the combined entity. So we will look very much at what the project thinks will be the use of this accrued own funds. And we expect that this will be used again to increase the sustainability and not, to be clear, to be distributed immediately. Because this will create immediately a fragility, which does not mean, of course, that there can be no distributions. It just means that we don't expect that the badwill generated will be used essentially to be distributed to the shareholders. But it will be recognized and it will be there. And the third point, which was maybe more technical, but again, there was some misperceptions in the market that because it's true that from a legal point of view, when you have a new entity, you need to go through a new approval, new process of approval for the internal models, that people were thinking that a combined entity will lose the former approvals and will have a sort of limbo to where the standard approach to regulation will apply between the moment of the merger and the moment of the new approval. And this, we have already done that. In fact, these principles stem from our practice. We have already done it, especially for Brexit banks. Of course, we don't take a limbo situation. So we will accept transitions to have at the beginning non-integrated models, and this will be part of the integration to integrate them along the view of the integration plan. And we will accept these temporary situations, provided again that the integration plan seems to us to be credible. So we published that on the 1st of July. We are, as I said, in the midst of the consultation. We, as it is in the summer, we extended it a bit more than our usual consultation until the 1st of October. And we are very eager now to receive your feedback, beginning today, in fact. And we expect to have a revised version that will take into account the feedback we will get around the fourth quarter of 2020. So that's for the introductory remarks, I think.
Thank you, Edouard. This was great, very clear, very pragmatic as to what the market may indeed like and expect also from an assessment of the transaction. Diego, what is, in your view, the market reaction to this? How do you see it?
Thank you, Elena.
Sorry, before we start, Mr. Fernandez-Bollo, could you just stop sharing your presentation, please?
Of course.
Thank you.
All right. So in discussing potential consolidation between European financial institutions, Elena, I'm always reminded that investment bankers, or former investment bankers in my case, are the only ones that have a worse track record than economists. Economists have forecasted 10 of the last 5 recessions. Investment bankers have forecasted 10 of the last 2 European banking merger waves. So I have decided to take an uncharacteristic approach to this and actually focus on the skeptical points of why consolidation today is quite difficult and why the proposed approach by the ECB that Edouard has just further explained to us are important. The first is that while it is the case that the clarification and the latest ECB elaborations go very much in the direction of sounding encouraging to European bank CEOs and bank boards, that is particularly the case for smaller and medium-sized deals. And it will particularly depend on how the ECB takes the very first opportunity to, in particular, show that the elaboration on the P2R and PGR are going to be constructive, if you wish, in terms of thinking about the combined entity. For the larger institutions, unfortunately, the biggest obstacles don't come from the ECB. The biggest obstacle by far to consolidation among and by any of the global SIFIs comes from the FSB and the G-SIFI buffers. And the G-SIFI buffers in a world of bank valuations that are defined as small fractions of tangible book value, unfortunately are such that the addition in capital needed to account for a transfer into a higher G-SIFI buffer make it extremely challenging to think of any transaction, particularly of the cross-border, complicated and large type. The second is that the dichotomy between the ECB and the local banking regulators remains. And the ECB, and I'm not saying this just because Edouard is listening, the ECB has done an amazing job of being a regulator to large and medium-sized banks in Europe. I have interacted with regulators all of my life, mostly for this that didn't happen, not necessarily because of regulators, but for many other reasons. And I can tell you that dealing with the ECB is a joy compared to dealing with the local regulators in the past. It's consistent, it's thoughtful, it's constant in terms of feedback and interaction, it's proactive, it's all that you would want to be. Unfortunately, the local regulators still play a part, and the local regulators sometimes have a mind of their own. And for large and complex institutions, this can create an obstacle. So this is the first consideration. The second obstacle to consolidation more broadly, particularly for the cross-border and larger transactions, is the current nature of the shareholder base of banks. If you look at bank shareholder bases these days, and you start from the large, most successful banks closest to tangible book value, and you go all the way to banks that are felt to be almost in distress and trade at tiny fractions of book value, you'll see that banks are held by deep value investors, hedge funds, and indexers. Growth investors have fundamentally disappeared from the shareholder bases of European banks. And unfortunately, growth investors are vital for growth plans. I appreciate that it sounds obvious, but if you are thinking of a transaction where you need someone to take a long-term view, to accept substantial restructuring costs upfront in the face of great synergies to come, that are ready to put money to work, even at distressed, or even better, at relatively distressed valuations in order to reap benefits later. Unfortunately, a base made of indexers, of hedge funds, and of deep value funds is not exactly ideal. And again, managements across the European scene today have to contend with that. Last but not least, and it would be remiss not to talk of the big C, of the big COVID, the current uncertainty brings an impact that weighs on the mind of management. And it is that the ECB now in its more broader term, not just as a regulator, but as the central bank of the system, has done, again, an amazing job in terms of supporting banks, and TLTRO and everything that has gone in the direction of banks to try to help the real economy is welcome, necessary, and has been done in large and substantial quantities. The problem is that some people might have exaggerated with it. It is difficult to say what lies inside certain balance sheets in terms of arbitrage trades, of carry trades, or of large volume growth of loans that sometimes might look virtuous in the first instance, because, for example, it might be a volume growth of loans concentrated on state-guaranteed loans, but state-guaranteed loans carry a sting in the tail, which is when the guarantee finishes, how will banks deal with saying to people, well, while you were state-guaranteed, it was one matter. Now that you're not state-guaranteed, we are going to have to deal with you in a different way. And so bank management, and as, of course, every bank manager thinks that they are the only ones that manage risk properly, which ultimately is the most important thing that a bank manager does. Leave aside growth. Risk management is the key, is number 1, 2, and 3 out of 5. When they look at other people's balance sheet, think what is lurking in there. And today, the murkiness of those balance sheets from the outside is particularly perceived by bank managements and, frankly, by investors alike. I think I am within my time, and I'll pass the word to Andreas for his comments.
Thank you, Diego. Indeed, Andreas, please.
Yeah, thank you, Elena, and good afternoon to everybody. I hope you are all well and safe, and stay away from the virus. Now, I will, much has been said, and I will be starting quite generally thinking about bank consolidation before I go more to the topics. And as Elena said at the beginning, I've done bank M&A myself, as has Diego, and but I've also been, contrary to Diego, at the side of Edouard in the supervisory board. Now, what are the 4 reasons why we talk so much about this topic? Let's start very generally. And there are 4 reasons why bank consolidation is so important. First, the banking sector in itself and big banks, large banks in particular, have dominated large segments of the European economy in the 20 years before the global financial crisis. They don't do so that much anymore, but that's where we are coming from. Second, we talk so much about bank consolidation because we are probably overbanked. There are many studies out there, including from me, but we are still very dependent on the banking sector in Europe. Just look at the size of the banking sector to GDP, but you could look at other measures. Banks have strong political influence. They have very large payrolls, and look at the sheer number of banks. So we are probably in Europe overbanked. Third, the banking sector is in fundamental transition. This is not the place and time to talk about digitalization, but the transition, like in other segments of our economy, is very large. And fourth, Edouard mentioned it, there is poor profitability. And that's why consolidation is talked. So Edouard said that the ECB has no bias regarding consolidation, and that's very, very good. I would like to go to 5 scenarios of bank consolidation I can see, and everybody who is listening can sort of put himself or herself into one of those scenarios. Now, the first scenario is that the banking sector will continue to shrink to health. There is not going to be any M&A, but it's going to shrink as it is shrinking right now, and it will be healthy after that. The second scenario is that we will see mergers and acquisitions, which then will lead to a concentration of the market with a reduced number of banks. The third scenario is that we will see domestic consolidation first and cross-border consolidation at a later stage. The reason for this is that domestic consolidation, which is actually happening, gives more synergies, and many large banks wait for cross-border consolidation for the completion of the banking union. My fourth scenario would be that we do not only see mergers and acquisitions amongst European banks, but that we see a lot of crossings of established limits of the banking industry. So in the past, banks have merged with banks, or banks have acquired banks, but this may be very different going forward. The technology aspect is only one of them. And my last scenario would be that we may not only be looking at European banks consolidating, but we may well be looking at, let's say, US banks buying European banks, and this is not a cozy European atmosphere. It may well become very international and steer up European consolidation. Now, let me continue with 4 minimum conditions that I consider important for bank M&A. And this is, Edouard, a little bit also my feedback, which I would, sort of give in today's session to the ECB. What are minimum conditions for good mergers and acquisitions? It may be very banal, but I'll say it anyhow. First, those mergers are best if they are planned, if they are purposeful, and if they are done out of conviction. And I mean done out of conviction rather than out of compulsion. If you need to do a merger, if you need to buy a bank, let's say for bad will reasons, this is not a good strategy. So M&A strategies have to be like any other good strategy. They have to be planned, purposeful, etc. Second, such strategies or such M&A activities, they need to be analytically based. They need to be quantifiable upfront. And I think that's what you mean, Edouard, when you say you look at the sustainability of those issues. Yeah. So, economies of scale, synergy effects, etc. They need to be as clear as possible upfront. Third, any good M&A strategy is far-sighted. It's looking quite ahead at different scenarios. What if the economy changes, etc., etc. So as far-sighted as possible. And fourth and last, that's my personal favorite, good M&A is creative. It looks beyond the existing business. It's not sort of drawing a linear line of where I am now into the future, but it imagines structural change. So let me finish. Where do I see the future of M&A? I have very little doubt that bank consolidation will continue, but, and that has not been said yet, M&A is not a magic formula. It is one possibility. By far, it's not the only possibility, and you always have alternatives. As the SSM writes in its paper on, we are debating today, there is no size fits all, and it's very difficult to sort of predict what's best in each and every situation. But I also strongly believe that M&A is needed for the recovery process of the European banking sector. It's really needed because banks can simply not carry on as before. And that's why we need to talk, and we need to have a stable banking union as a framework for everything which is in this paper. My very, very last remark, Elena, is that I strongly believe that supervisors must not work against the banks, but they must support them. And I see this consultation as a means of working with the banks, and that's why it's good to have this dialogue. Let me stop here.
Thank you very much. So thanks to both of you for your remarks. So maybe first, before opening the Q&A, maybe we give the microphone back to Edouard for his initial reaction.
Okay, thank you, Elena. First, well, it's difficult not to agree with what has been said. Even on the skeptical side, again, it's not because we are trying to push for progress that we don't see what are the obstacles and the difficulties for progress. It's rather the other way around. It is because we see that there are difficulties that we are eager to keep pushing, again, doing what we can and in the limits of our supervisory role. So some consideration from the supervisory point of view of the ECB. First, when we say we have no bias against any consolidation, that means also that we favor all types of consolidation. You said there could be small size, middle size, big size. What we want is to have good projects of consolidation. And you can have good at all the levels. You can have also bad, like Andreas said, at all the levels. Where two banks that are doing bad try to merge to escape, that could be kicking around the can. That can be bad at each level it is. Even they are small, middle, or big. So you can have both. And what we want is to judge on the merits of the project. And a thing that as ECB I want to seize any occasion to repeat is in our mandate there is the diversity to preserve the diversity of the business models in Europe. And we are very conscious of it. So we are mindful to see progress for the small banks, for the medium banks, and for the big banks. This is really in the remit of supervision to take that. And I will say, this leads me to the second point, that for us, even when we are speaking about the Eurozone, there is no difference between cross-border and domestic, because from our point of view, which is a point of view supervision, this is the only point of view where we can say we have a single jurisdiction and we are completely unified. So we don't make any difference, and we will judge in different ways. But of course, we are very conscious of the fact that there are differences, and that there are additional obstacles to take up what Giorgi said for big banks if they go, for instance, into the SIFI buffers. Again, taking one thing that Andreas said, I hope that the merits of the case can be such as not to be completely drowned down by a purely regulatory issue of SIFI buffers. But I would also like to remind that as we are speaking, there is the EBA consultation on the possibility that is now given in the European framework to consider Europe as a single jurisdiction also for the for calculation of the SIFI buffers. Not, of course, for becoming a SIFI, that's not possible, but for going to one bucket to another. There's a methodology that is now in consultation, and then I will hope very much, at least this is clearly the position of the ECB, that this methodology will be finally approved by EBA in this autumn and could be used by the national competent authorities, and we will reflect that, of course, also in our ECB role, as starting as for next year. So even one of the issues that Giorgio has taken up is an issue that can be, I hope, at least mitigated in the new framework. That will not make this issue disappear. Be clear. I'm not saying we are going to see a wave of enthusiasm of cross-border consolidation, because of course we've seen, for instance, a lot of national guarantees given. So I expect that maybe some countries will not welcome very much cross-border consolidation to take use of their national guarantees. So that could be an issue. We are not blind to the difficulties, but we think it is important that on the prudential supervisory side, we encourage all good projects of consolidation, whatever the situation of the different banks. And as about the current uncertainty, it's true. There is a current uncertainty. So we expect that it will be more easy from the market to put up projects when they will have more certainty. But again, here we are supervisors, so we are waiting for the projects. We are not doing the projects. We are not pushing the market to do. What we are here is to look at the project they come. It will be natural that we will have more projects where will be less uncertainty. But what we see is that today, there can be projects. Elena is Italian, so everybody knows that in Italy there are some projects. I will not speak about Diego, of course, of individual banks, but there are some projects, and this is not the only country. So I do not think that even with the uncertainty, there will be no projects. On the contrary, we expect to have some, and there are some that are on the board today, and clearly, because we cannot talk about individual banks, but you will see that what is in our paper, we live up to it. And this will be applied on all the projects that, again, projects that we assess as credible, that we assess as reliable, that we assess as increasing the resilience. So on the issue of, for instance, how do we calculate our P2R and P2G requirements, we will abide by that. And we are in the process of abiding by that, but on the projects that we have. So I'm confident that the market will see that we will, that in fact we will apply, we apply what we say and we say what we do. This is all the project of transparency and clarity. Again, if I turn to Andreas' minimum requirements, well, I just can say I agree. This is exactly the things we will be trying to look. When we say we are credible, we want credible plans, we will be looking whether there is sufficient scenario variation. If they only take rosy expectations, we don't think this is a credible merger plan. If it only works when everything, the climate is very good and everything is going forward in an excellent way, this is not a robust plan that is sufficiently robust. We will, of course, look at and this is even the core of it, at the rationale, the business rationale of the plan. This is what we need, a strong business rationale. And this is why we are ready to give time to a good business rationale to develop and to be able to reap the synergies on time. This is exactly the philosophy with which we are approaching these issues. If we have a good plan that builds over time, we can accompany that plan building over time. And this is what we are trying to do. This is the signal we are trying to give to the market, because we want them to be reflecting now on good plans. So I think it's very difficult to disagree with what was said. So that's all for me.
Yeah. Okay, let me turn the microphone then back to Diego, because on this, exactly on that point that you just mentioned, we want good plans. And also Andreas said before, we want eventually M&As that are far-sighted. But then Diego was also saying that given the uncertainty of the COVID in particular, it's very difficult to somehow see in the balance sheet of banks what is there and what may eventually be there. So it's a moment of greater uncertainty. So what do you think, Diego, that supervisor or authorities could do to try to decrease this uncertainty to the extent possible? I mean, a little bit is connected with the unfolding of the COVID crisis, of course. But could there be something that authorities could do in order to increase the transparency of bank balance sheet and therefore making also far-sighted M&A in a way more likely, or at least more easier to evaluate?
Well, the obvious instrument that comes to mind in that respect is the use of the regular stress testing periods and routines. There is flexibility, there is plenty of flexibility from that point of view to switch from traditional routines to very specific requests and to very specific tests that can be tailored to the current needs of the post-COVID era. So that seems to be the absolute first thing. The second is to continue on something I mentioned before, is the ECB is a very peculiar and very involved and very talented regulator. The ECB has the kind of detailed debate on single positions, on single situations, a debate with every risk committee of every bank that allows it in its ongoing pronouncements to assuage market fears that what they see inside the banks is relatively healthy. I mean, obviously they can't comment on specific cases, and they have to be careful not to give blanket absolutions for people that might not deserve it. But the general tone setting of the ECB, going to what Andreas was saying about the balance in regulation between ensuring risk protection and fostering profitability, the ECB can lean forward in saying that they encourage, that they are looking into banks and that they think that what they see is good, and that they continue to be favorable to banks trying to achieve decent levels of profitability that will then in turn support the real economy. I would just veer off tangent for a nanosecond on something Andreas said before. Andreas said the Americans might come into Europe. All of it could be. What worries me more today as a European is that the Americans don't even need to come into Europe to do all of the business that our large corporates need to do, for example. These days, if an American corporation wants $20 billion from a single American bank, they can get it. There's at least 2 banks in the US that have single statutory lending limit in excess of $20 billion. There's none of that in Europe. If I am Siemens, Michelin, a big European corporation, who am I going to go to when I'm being ambitious and I want to take advantage of opportunities? So the ECB has a large role to play. I agree, Elena.
So on this, let me go back to Andreas. So there is a question from Wilson Erwin, who is the Vice President at Credit Suisse, and he and a good friend of the Florence School. So he sort of come back to this issue of national versus cross-border mergers. So Edouard said, we don't favor any of the two in a way. But as Diego said, we need also bigger banks in Europe in order also to compete with the Americans. So on the other hand, also, before Edouard said that we don't want fragmentation in the European market, and instead the crises are always a retrenchment from the single market towards fragmentation. So in a way, if we see domestic mergers, because somehow they are the easiest to be done at the moment and to grasp synergies, don't we go a little bit be back relative to the single market idea, and at the same time we decrease competition significantly in the banking sector? So in other words, first of all, how do you see the domestic mergers versus the cross-border? Would you see would you favor one of the two? And in case it is the cross-border, or at least partly the cross-border, what can we really do to make this happen? So would we need something much more dramatic than the supervisory guide?
Yeah, many questions in one question, I must say. Now, I am still, despite the fact that I'm out of the cooling off, I'm still a supervisor and central banker at heart. So I also believe everybody decides on themselves whether they want to do domestic or cross-border merger, and it should not be the state or the government or the supervisors or anybody else to tell them what they should be doing. And it's also not the idea to have incentives, economic incentives for either of the two. Having said that, you know, of course, in principle, there are two types of mergers. There are the mergers which you do for cost-cutting purposes, where you have similar business models, and you just, by having a bigger market force, you try to make more money and you try to increase your margins. Now, that is normally better in domestic environments, in countries where the markets are not that much consolidated, and the big 3 banks or big 2 banks or big 4 banks don't have too much of a market force or market share already. Cross-border always has complexities for different economic policies, for different insolvency laws, for deposit insurance schemes, for many other differences, which were also partially mentioned before. So plus it has cultural changes, it has employment rules which are different, etc., etc. So the complexity of a cross-border merger is higher. You have less possibility and less need to cut personnel. And normally cross-border mergers are complementary mergers rather than, also because of different clients which are involved, than domestic mergers which normally address the same clients and no new clients. I believe we need European consolidation. If you look at what's the market share of the largest 5 or 10 European banks vis-a-vis the market share of the largest 5 or 10 US banks, you'll see that we are much more fragmented. Yeah, a lot more fragmented than Europe would normally deserve. So we do need European consolidation. We need not only a banking union, we also need a capital markets union to help. If you securitize a loan in Germany, you know, let's say an automotive loan, and why not having bigger pools of securitized loans, let's say also with Italian cars and French cars, etc., etc. So we need a lot more harmonization, and the SSM is helping. But without the capital markets union, especially not without the banking union, European consolidation may not be as quick as we would like it to be. And my fear is that American banks will just come in while we think, okay, we are still in the mode of European consolidation. American banks will come in and buy European banks on the cheap. You know, Diego mentioned the difference to tangible book value, which is very large right now. And just buy on the cheap and just buy early on, and then reap the benefits of all of this. Of course, we have open economies, and any American bank can buy in Europe. On the other hand, we should not wait and debate too long in the European banking market, because we may not be the only fish swimming in our pond. There may be others looking at our pond, and buy banks at 20-30% of its tangible book value, even without any need for badwill recognition.
Edouard, back to you. So there are some people that are asking, to some extent, whether you're new or if you wanted this guide and this principle could or should also be applied retroactively. Meaning that there are banks that have done previous M&A transactions that are still stuck, for example, with the internal model. Could we think of doing something retroactively to help also banks that have undertaken mergers in the past? This is the first question. And another question is, this principle that you have highlighted to us in the guide, would they be applying to any type of mergers? So between banks, we said already of any size, but what about the state of solvency? Meaning, what about if the target was, for example, part of a resolution procedure? Would there be the same treatment, or would there be a different treatment?
Okay. Well, first, retroactively, you know, I have a legal background, so I shiver a little when I see when someone says to me that you should apply retroactively things, because this does not go in the sense of the trust, the confidence, the stability of the decisions. But if what is meant by that is we are ready to apply the flexibility to, for instance, the P2G, but this is something we do to the day, all day long. This is not retroactively. This is that we have to reassess at each point of time. And for instance, the P2G, the models, we are reassessing it each year regarding to the particular situation of a bank. So of course, everything that is there is something that a bank can use in its discussion with us. But of course, this will depend on our judgment on the present situation of the bank. What is different from what we have in the consultation paper is, in the consultation, we are speaking about a project. And we are saying we are assessing a project. And in assessing a project, we are ready to go for uploading some of the benefits. When we have not a project, we cannot upload future benefits of something that is not coming. So we will apply exactly the same principles, but to the present situation. So again, this is why it's a mixed answer, because it's a mixed reality. We cannot apply things that apply to a project to a thing that apply to a real situation, but for the real situation, the same principles apply. And we are ready. If they are doing internal restructuring, for instance, you can have internal restructuring, not necessarily M&A. They can come up with a project of internal restructuring, and then we will look at this. And we will look with the same principles. Again, for us, it's extremely important to be consistent, to apply the same principles, either cross-border, either domestic, big, medium, small. It's important that we apply the same principles, of course, with the proportionality that is needed for the different situations. This maybe is a way of beginning to answer your second question. Again, we apply the same principles to any size of merger. But if you go to the very, very legal question about a banking resolution, then you know that we have to take into account the SRB there. Because a banking resolution can, in some conditions, be waived some of the requirements of normal supervision, but that should be done in full agreement with the SRB. So we can do it, we are ready to do it, but it's a very specific case that we will not be dealt in detail in this guide, to be honest, because we need to engage more than, in all, by the way, we say it in the guide, in all cases we will engage with the SRB. Because you know that Merril, for instance, Merril requirements will be very, very important. I expect that when they will become, they are in the process of become binding. This is one of the issues that the banks will want to have clarity about on the way to a business operation. And this is the SRB responsibility. So our responsibility will be to bring together SRB, ourselves, and the bank, so that the bank can have a global picture of what will be the requirements in the banking union. SRB is, like us, banking union authority. So again, to do that. And I don't want to speak for the SRB, but they have been fully consulted, and we are fully involved.
Let me change the order. Let's go to Andreas back for one point. So there are some people in the Q&A that point to the fact that it's not just a matter of synergies, but there is also an important component of capital and the liquidity and the funding in general, in particular when looking at cross borders. And Diego before mentioned that there is the SSM on the one end, but there are the local supervisors on the other. And we know that in particular in times of crisis, there tend to be a lot of ring fencing from the local supervisory perspective. So what do you think we could, or to which extent we can think of reaching an agreement in imposing waivers or not having trapped liquidity, trapping capital. And I'm asking you, because if I may say, Germany is normally one of the countries that is very somehow concerned with this. So at least has been, among the biggest countries, has been on the side of not wanting free movement of capital and liquidity within the single market. So that's why I'm...
Yeah, let me close my window. Somebody is coming. Hello?
And Diego, be ready to see whether his answer then satisfies you from the side of the market.
I am on my holiday house and somebody is more, cutting the grass now. So I don't want you to all listen to that. Okay, now I got the question. There is a contradiction. If you want a European supervision, there needs to be a lot of harmonization. And we are not 100% there. We are, I think we will get there. And the national interests have to step behind European interest in almost all of the cases. And when I was in office and I was sitting on the supervisory board when it started out, I've always been fighting for European harmonization and against ring fencing. Now, there are obviously some differences in accounting, and there are some differences which are not that easy to overcome, but there are plans of how to overcome it. And it's always good to speak to your national supervisor, but at the end of the day, for banks exceeding balance sheets of 30 billion euros, you need to talk to the ECB. Now, the idea is that in your joint supervisory teams, you always have a combination of ECB and local supervisor. And because a lot of work is still done with the local supervisors will always play an important role. The biggest part of the SSM is with the national supervisors, as Edouard knows himself, being, while he was at the Banque de France. But clearly, the ECB is in charge, and the ECB is calling the shots. That's why I am very much against ring fencing. If you want a European supervision, if you want European bank consolidation, to go back to national ring fencing does not make much sense. And I am a big advocate. I will continue to be a big advocate for European solutions. And I'm saying this as a German. My successor thinks the same way, and the large countries always act in the same way. That's why that's why the supervisory board is so complicated. There's so many people on the supervisory board, and discussions, at least when I was there, take so much time. Yeah, sometimes you wonder, but it's a way of finding the compromise, finding the European compromise, and that's why also we need to make further steps in the banking union and the capital markets union, but especially in the banking union. And Edouard is my witness. I organized a conference together with a good friend on EDIS on that topic, because we need to get there. Now, the question is, if you want to get there, my biggest belief is you have to go step by step. One of the biggest mistakes in the European way of life, so to say, is that we want to jump all the way ahead to the final solution. And then you leave a lot of participants on the way and you create resistance. You have to have goals which are ambitious, but which are realistic. And you have to go step by step, but sustainable, on a sustainable path. And that's why sometimes very, very too ambitious requests won't be successful. You have to go with realistic goals, because the overall goal is to have a European harmonized system. And that's why I believe that the bank managers I talk to in Europe or in the Eurozone, they see that. And COVID-19, as mentioned before, is amplifying the issues. And they really think about European consolidation, of having a plan. What if I get a hostile bid? What if, who would be my preferred partners? Whom should I talk to? What would be the principles I should talk to? What could the ECB think about this? Where are my headwinds and where are my tailwinds? And there is a lot of planning being done and thinking, but it's not really the issue of national ring fencing at the forefront of these debates. That's not, at least my impression. It was so in the past. Yeah. Diego is now sitting on a board of a very large European bank, which has operations in several European countries, including Austria and Germany, and there was ring fencing in the past. It would be anti-European and not something which would make a lot of sense to be sitting on the one side in European supervision, in European resolution, and on the other hand, going national. I don't think that would be accepted and acceptable.
Diego, to you the last word, because I see that we are finishing the time. So what would be your minimum condition to see, in particular, cross-border consolidation in Europe? You mentioned some before, but what would be, after this debate, what do you think you would ask the supervisor that they could do to favor, if we want to favor cross-border consolidation more?
I would say, I'm not going to repeat the conditions because the conditions are very obvious. Andreas did a great job of outlining and at the beginning. I think that what we need to see from the supervisors is just an enlightened application of everything that has been outlined by Edouard at the beginning of this presentation. They all make plenty of sense, but the devil is in the details. And the desire, let's put it this way, Andreas would have made my favorite national regulator 10 years ago. What he said was what you want to hear from a national regulator who says, I'm part of a bigger project, I'll do my job, but ultimately I bow to the fact that we have a bigger European project in this. And good intentions are important, but proof is in the pudding. And so the next one or two consolidation projects that will come out will be closely scrutinized by the markets to see if the ECB is actually putting in practice what it is saying. And it's not, by the way, I completely agree with the fact that it's not a matter of just being pro M&A. One is pro good M&A, but provided that the M&A is good, helping it will be clearly taken by the market as a de facto encouragement, which is all we need.
Okay, on this note, let's hope that, for example, also the meeting and the agreement on the recovery fund will be a boost also for the SSM supervisory board to move forward on the European project, because there is a clear sign that maybe European goals have gone beyond the simply national interest. So let me conclude here. I don't want to steal any more minutes. We have a lot of questions also, Edouard, on a particular aspect of the guide. We will be sending them to you, so hopefully they will be useful for you, for your consultation and your progress with the guide. And as Diego said, let's hope that we're going to see operations, transactions soon that will be positively assessed both from by the supervisor and the market. So thanks a lot to all of you again, and see you next time. Thanks a lot, and to all the participants again. Thank you, and bye-bye.
Thank you all.
Thanks to everybody. Bye-bye.